Welcome to MedTech Speed to Data, a KeyTech podcast. I'm your host, Andy Rogers, VP of Business Development at KeyTech. Each month, me and a KeyTecher are going to interview a MedTech leader and talk to them about the critical data-driven decisions they make in their programs. Hey everybody, welcome to MedTech Speed to Data. I'm your host, Andy Rogers from KeyTech. Very excited about today's episode. Throwing a little curveball in here. We have John Norris, Managing Director and Palo Alto based as well. He's with HSBC. John's very good at marketing. I found him through one of his annual reports that he puts out on a regular basis. So John, very much excited to have you on the show. Welcome to the show.
Thanks for having me on, Andy. Appreciate it.
Yeah. So for our audience, again, we've got a broad audience, startups, strategics, investors, parents. Hey, Mom. Share your background on, how you sort of evolved and grew in the ecosystem to where you're now publishing this report on a regular basis.
Yeah, the quick overview is, undergrad in business, went to law school, was a practicing attorney for a few years, and just realized that was not for me. I was in litigation. It was not a good set for me, who kind of liked win-win situations. Litigation is not a lot of that.
Yeah.
So I decided to do a little bit of a career change and start informational interviewing, looking for places where, there was win-win and it had more of a business context, and found my way into banking startup companies. So I joined that, started working in healthcare, had never been in healthcare whatsoever. And I just learned by doing. And I had a great mentor at the time. She took me around to every meeting she went to, and I got to meet the venture-backed companies that we were working with, and also the investors that were putting that money to work. And we did, banking those companies, but we also did something called venture debt, which is basically debt that allows, early stage companies to have a little extra cash in between financing events on the equity side. So it really kind of extends your runway. But when you do those deals, you have to talk to the investors, like, why did you make that investment? What are you expecting these companies to do? What's the next value inflection point? So it was a great learning for me to get into the ecosystem that way. And, that sort of goes into, what my role has been at the banking side. So I ended up doing venture debt deals for a while, and then sort of graduated to managing venture capital relationships. And that's kind of where the paper got started. I joined Silicon Valley Bank in 2006. Basically, I was the liaison for the healthcare venture investors. And in 2009, we all know there was a recession that was going on. And during that time, my boss was like, okay, I want you to develop deep and immersive relationships with VCs that are going to be here for the long haul. And I'm like, okay, so we're in a situation where it's a downturn. VC firms aren't raising new funds. A lot of funds are going out of business. How do I figure that out? And so my hypothesis was looking at near-term exits, looking who were the venture investors in there, who were the partners that were on those deals. Those were going to be the ones with the near-term attribution that, one, has the best sense for these VCs to be able to go forward. And two, those VCs, those partners that were on the biggest deals, are going to have the power in the firm. And so I put all that data together, and then I started to talk to VCs about what I found. And they're like, this is amazing data. And in fact, you should think about not necessarily publishing the data on the deals, but publishing data that really helps us in this healthcare venture niche. Because at the time, all we were seeing were, there was 50 M&A in private healthcare, and the average deal size was, 100 million. Like, that combines biotech and DX tools and MedTech. It's like, what does that even mean? It doesn't really help the people who actually are looking at that data every day. And so that's what got me started. And in 2012, I started putting out these papers, really actually looking at these different types of sectors, looking specifically at med device, looking specifically at diagnostics and tools, as well as biopharma and health tech, with the idea that this is an opportunity to educate the industry on what's going on. And if they find it helpful, to give them the context to where they are in this market, as well as information around valuations and who the active investors are, et cetera, that is good for the industry. And then if I'm the person who's putting that together, it's good for me within that industry and the brand building for my organization. So that's kind of where everything kind of came from. And what I found is once I started to put this information out, people really enjoyed it and they started looking forward to it every year. So I was doing it annually. Now it's every 6 months, and
Right.
then I'm constantly chatting at conferences, et cetera, about what's going on in the market. So that's kind of the origin story for me in the paper.
Yeah, no, hey, great background, John. I mean, I love your comment about it's good for the industry. You don't hear that enough. You know what I mean? Like everyone is trying to stay in there, unless you're in like, I don't know, government role or something like that, where you're trying to just grow your geographic region. Most of the interviews are like, how do I get my venture going, or how do I make the most amount of money? You don't hear it's great for the industry, so it's refreshing to hear you say that.
Yeah, exactly. And my feeling is like, I want everybody to win, especially if I'm a bank, like I'm kind of a neutral third party. You need a bank account, you need venture debt, all that sort of stuff, but I want these companies to be able to get their next round of funding. I want them to get to that great exit. And for me, it's about sort of good karma. Like if you can help these people, give them as much information as possible so that they can make targeted smart decisions for their company, then they're in the best position to win. It doesn't always work out that way. And we can talk about where we are right now because the market is a tough one. And there are companies that aren't going to get funded. But if you give them enough information, then at least they have that as the context to try and make the best decisions for them.
Yeah. So quick question on like how you generate this report. You've been doing it for 13 years, it sounds like, on that order. Are you using like, you can't just be talking to VCs like every day and like compiling this information. Are you using like PitchBook, or just for our audience, just a
Yeah.
snapshot on how you're generating the report? Because I do think it's inspiring, right, to help the industry. There's other ways to do what you're doing that, are outside of banking that just kind of, I'm curious how you actually put it all together.
Yeah. So I do talk to VCs every day, but that's not how I put the report together in full. But let me give you so I look at it two different ways. So I look at both the investment side and then I also look at the exit
Mhm.
side. And those are two different data sources for me. On the investment side, I use PitchBook. And what I do, not necessarily secret sauce, but I basically am downloading all deals in the US and Europe that have any sort of healthcare classification. And then I'm going in and looking at every single one of those deals and I'm characterizing it myself. What sector does it belong in? What indication does it belong in? What's the modality? Is it a new investor that's coming in to lead the round, or is it an inside round? What stage is this company? And I'm putting in additional columns besides what I already have at PitchBook. But basically, I'm using the PitchBook financing data to categorize that in a way that helps people understand what's going on. And so if a company needs to have raised at least $2 million in financing to qualify for my list, and then I'll follow those companies for whatever financing they do after that. But then all of a sudden, what that does is you start to create a really rich set of data that looks at the different financings, and this is especially interesting, let's say in biopharma, for example, where you do the stage of the asset at the time of the financing, and then they do another financing. The stage is different. They may have shifted focus, et cetera, but you have this really interesting, like rich tapestry of data. And, I will say PitchBook tends to shift their data a lot and change their dates. So I'm constantly going in there to make sure I have the data that's as correct as possible and make sure I'm not having duplicates.
Right.
But that's the financing data. And so I'm adding, let's say, 6 or 7 extra data points on top of that PitchBook data so that when someone comes to me and says, what's going on with a Series B med device cardiovascular focused deals over the last year and a half, I have some really interesting data points to share with them about what's going on, what pre-money valuations look like, who are the active investors, et cetera. So that's the financing side. On the exit side, I kind of do that on my own. I have like a bunch of different news sources that I pull from. And what I will say is that I've looked at some of the PitchBook data on the M&A side. I think they don't quite do as good a job as I would like them to. So that's why I kind of do it on my own. And so I'm constantly looking for the publicly available data. And then if it's undisclosed, maybe I talk to enough people to get a sense of what those dollar amounts look like and put together like a really interesting, like, a myriad of sources to get the very best exit data that's out there.
Right.
And so that's kind of how I put that data together. So it's basically two different ways of doing it. The financing side is PitchBook, that then I'm going and looking at websites to actually characterize what these companies actually do. And then on the exit side, I'm just gathering from a whole bunch of different sources.
Yeah, that's helpful. And as you're talking, it's just, again, why are you doing this? Clearly it helps, people consume but really you're just trying to present a picture of the market, right? So that you can make the best decisions that you need to for your shareholders or yourself or future, impacts on your business.
Yep, exactly. And on that note, like you get this data, and all of a sudden, like, you sum it up and you look at it by
Right.
by sector, and
Right.
you look at it by indication, you look at it historically, and all of a sudden things emerge,
Mhm.
trends emerge, and then other trends that you think, oh, I wonder, like, why is this happening right now? What does that look like from previous years? And that's sort of the interesting additional context that we add to the reports that we put out. It's great to just show what's happening, but the question is, why is it happening? What's happened before? And what does that mean for what's going to happen in the future?
Yeah.
And that's really where the conversations with companies and investors come in. Like, that's the anecdotal additional context that the data needs. Because if you're just showing the data, data can be cut and melded in lots of different ways, but you're trying to present like the most honest picture of what's going on in the market. And that's what I try and do.
Yeah. Yeah. And the podcast, right, is called Speed to Data. And I think if someone asks, why do we call this podcast Speed to Data? You're ultimately trying to make decisions, right? So you need data, you need it quickly, you need clean data because everyone needs to make decisions and you need that edge, right? So let's get to the meat of our podcast. So, Speed to Data, you talked about it a few times already. So I want to structure it like sort of past, the trends you've seen in the market, and then we'll talk about present, where we're at, depending on what's on CNN right now. I don't know what's happening right now. And then in the future. So past, clearly it's been a slog, maybe is a word that might come to mind with venture investing in certain segments of the market. There's always opportunities out there. First, can you describe the different markets that you cover in your report, and then maybe comment on, in the past, where the headwinds have been coming from, the lack of VC funds?
Yeah. So when I look at the data, I sort of think about healthcare venture in the US and Europe. I do med device, I do biopharma, which is therapeutics based. Then I do diagnostics and tools, which I push together because they're reasonably well related. And I think if I looked at one as a separate sector, it's they're both on the smaller side, so putting them together makes it a little bit easier. But I do look at specifics within those sectors. Then I look at health tech. And just for an example, when you think about a imaging company that uses just software and not a piece of equipment, that goes in my DX analytics within diagnostics and tools. But if they have a piece of equipment, it goes into device imaging analysis. So I look at these deals and I kind of figure out where they should go and how I think about them. When you think about where the headwinds are coming from, I think, yeah, you have to go back a little bit. And I won't do a long overview of this, but 2021, just think that was record-setting year. That was the apex. Every record that could be set for deals and dollars, et cetera, in 2021, that was set across all the sectors. And then mid 2022, you started to see the fact that biotech companies were having trouble going public. People were sort of seeing a little bit of a downturn in the market. That's when the downturn sort of started. 2023 was a year of retrenchment. And that means all the VCs that had done all these, what you might call frothy in terms of valuations, all these investments they did in 2020, 2021, early 2022, they had to go back in and look at their own portfolios and say, does this company have enough capital? And what is the milestone that's going to actually enable that company to raise more money? And that was sort of a lot of inside rounds. So we saw a decrease in funding in 2023. And that sort of set the stage for, once you went through your portfolio, then you could figure out where you are and how do you want to put money to work. And that was really 2024. And we saw increased investment in 2024, but the number of deals actually didn't increase. So you do the simple math, you say, okay, these are bigger deals. And that's kind of what happened. And that's where you started to get these mega rounds. And the question is, like, what what is a mega round accomplishing, and defining for you, like mega round for me is $100 million private financing or bigger. And why are these investors doing such large rounds? And what are these rounds all about? Basically, they're smushing two rounds together and they're extending the amount of investors that are coming in to support that round. And the answer to the question is, why are they doing it? Is they want to mitigate financing risk. What they don't want to do is not give the company enough money to get a value inflection point that allows a new investor to come in and do the next round. And so when you started to see all those issues coming up in 2023 and 2024, it was a lot easier to just raise a really big round. And so you have enough money and time to get to a value inflection point. But if you don't, there's enough investors around the table with their dry powder they have to support the investment to do more investment on top of that.
Right.
And so it's a risk mitigation technique. But what it does, it also, because you're raising so much money and your valuation is so high, it does cut into the potential multiple you can get on the backside when you're looking to M&A and you hope that there's an IPO window to go public. You're at a much higher valuation you would have been otherwise. So that's the risk they're taking. They're capping their upside, but they're mitigating their downside by making sure there's enough money around the table. And that kind of sets us up to where we are now, which is still a function of where we are with the mega rounds. We also are dealing with what we haven't seen yet, which is a bottom in the market. But I'm happy to go into that in a little bit more detail.
Yeah, let's just go back for 1 second. So, I mean, the mega trend of free money and low interest rates in 2021, and then you're coming down off of that high. That makes sense. And then the other trend you mentioned is more or less VCs with the means reinvesting into their portfolio companies with larger dollar amounts where it makes sense. Basically, seeing which ones they have most promise and putting more money into those, and then as you say, that extends the runway, extends the time to an inflection point, maybe keeps other investors out, but it hurts their potential upside. But so that I hadn't appreciated that trend. That's really helpful to understand. In the past, the last 2 or 3 years, I meet a lot of startup companies, right, that are looking to go from their angel funding and grants to their first venture investment, and they're having a very hard time doing that, right? And so, because they're swimming upstream, because of the interest rate trend, because of the trend we just described, the funds want to reinvest into what they already have. They want to recoup whatever losses they might get. What advice do you have for those types of companies? Maybe knowing what you know now, what could they have done differently in these last couple of years to get that VC funding in that environment? If you have any learnings.
Yeah. Thanks, Andy. I would say, maybe there's two trends that are driving things, and maybe I'll get back. Then I'll circle back around to what companies can think about doing. When you think about the venture investors themselves, you think about like what makes these folks tick. Like, they want to continue to raise new venture funds because they get paid management fees on that. But in order to raise their new venture funds, they have to show their investors, which are the LPs, that they've actually, gotten returns. And those returns are either M&A, where a company gets acquired and they get the money back based on their ownership, or the company goes public and after the lockup, they're selling shares, et cetera. And so they're very focused on getting to exit right now. And so what we've seen is, one, that's why they're so focused on their existing portfolio right now, because they want to maximize those companies' chance to get to exit. And because of that, they haven't been doing as many new investments. But two, when they want to do new investments, they're so focused on getting companies to exit that's where we're seeing such a fall off, especially in med device and in diagnostics and tools on the early stage investment side. Because one, it takes a while for these companies to get to exit. And if you actually look at the data on MedTech, for example, last year, the median time to exit from their first institutional round to the exit for at least $50 million up front, it was 11 years. 11 years. That is a long time. And so these investors are so focused on exits that they're trying to do whatever they can to shorten that time. And so they're looking at these later stage deals. So what's interesting is, while the dollars are actually up in some of these sectors, especially med device, you're seeing that being put to work on a lot later stage deals because they'd rather get a shorter time to exit potentially. They'll give up those multiples. The second part, maybe I'll finish with, is the Series B. Series B, I mean, Series A is really hard, Andy. We all know that. Like everyone's trying to raise their Series A, but the Series B has been extremely difficult for Series A companies because Series B typically means you haven't really shown a lot of revenue or you haven't taken all the technical risk off the table, but you've shown you hitting some development milestones. But that's not necessarily enough for a Series B investor to come in and put more money in at an up round. So if Series A investors don't see Series B investors coming in with step ups in their rounds, why are they doing Series A to begin with? And so you're having that issue. And so what we're seeing for early stage is that people have to, maybe rethink about how they're going to put their round together and almost have a mega round mentality for them, squeezing like how many things can you do at the same time that's going to take as much technology risk off the table. And it's almost better to have a bigger dollar amount you're looking to raise than a smaller.
Right.
If you're looking to raise sub 2 million, that's one thing. But if you're looking to raise $5 million, it's almost better if you're looking to raise 12.
Right.
And it sounds weird, and I'm not being flippant about it, but the idea is that these venture investors, they want to put their money to work. They are looking to syndicate with other investors to take some of that mitigation to the next round risk around off the table. And if you're just raising $5 million, you have one main investor. That main investor is on the hook should you not be able to find a new investor for the next round. They would much rather share that with a co-investor or two. And so if you can raise more money and basically, think about development milestones where you're doing multiple things in tandem to take that risk off the table, it's almost better to be looking to raise more money than less.
So that's your advice. That's your advice is to try try and raise more money.
It sounds crazy, but also your traditional venture investors, they don't want to write small checks right now.
Mm-hmm.
They want to put money to work, and so I feel like they'd much rather do a $25 to $30 million Series A than a $5 million Series A. And they want to syndicate that with other like-minded investors. And so that's one thing I would say. There are a lot of small investors that are around that are willing to engage, but that market is super stratified. And it's a mix, Andy, of like angel groups and corporates and hedge funds and family offices and innovation centers and geographically focused groups. And it's just like I'm seeing a lot of these rounds that are in the $2 to $5 million that have like 7 or 8 different groups that frankly I've never heard of who they are.
Mm-hmm.
But these folks are cobbling together, smaller checks and making it work. So it can happen. It's just it's a lot of like herding cat sort of mentality.
Yeah.
Figuring out how to thread that needle because venture investors who want to put money to work right now, even in a tough market, it's like they're going to do one deal in a certain indication at a certain stage, with a certain market. And how do you thread that needle to like find that right investor that's interested in your project? It's tough.
It's tough. Yeah. I mean, I think you covered a lot of different things, but maybe let's just step up to like observe this ecosystem for a second and talk about present day and in your report, you mentioned, quote, difficult exit environment. And really, I think that, you can point fingers everywhere. What's the cause? I mean, it's the low interest rates and a lot of people that were getting money that shouldn't have gotten money because there was money to be invested. But at the end of the day, like you said, if the VC investors cannot show results, meaning an exit, they can't raise more money, and that's hurting the ecosystem. It's compounding effect. So, can you talk a little bit more about what it's going to take to get the exit environment to look more promising, and maybe that means more activity, more M&A, more IPOs. What will it take to get there? And again, I know the context you also laid is 11 years on average for these health tech or maybe diagnostics and med device placements to get to market. That's not helping the case, but then it's just a kind of a numbers game to show results. But can you just speak on what it's going to take to have a better sort of exit environment? And one last comment I'll make, it's not news that a lot of these strategic companies are having layoffs and shedding their numbers for a variety of reasons that everyone's probably aware of, that they're hunkering down. Right. And so at some point, I imagine what will help is a competitive market, these bigger players saying, if I don't do something soon, I'm going to get beat. And so that's when you kind of restart. But I guess those are my words. I'm curious from where you sit, what will help the exit environment?
Yeah, I think it's a couple things, and maybe I'll talk a little bit about the tools world, and then I'll talk about med device world as well. I think on the tool side, you know, one, what we're seeing is a lack of these mid to late stage investors that want to come in. We're seeing like the Series C type of investors that typically were growth funds, some of the corporate folks, and we're not seeing as much activity there. And one of the biggest impediments that we're seeing is frankly litigation. And when you think about some of the big players that are out there, they have been super aggressive about pursuing litigation against all these up and coming companies that have some amazing technologies. And it is really hampering these companies quite a bit. And so when you think about, a tough enough market when you're thinking about tariffs, et cetera, and how you're going to deal with that as a big company or even a mid-sized company that went public and are, maybe a couple $1 billion market cap. But the other thing is competition. And if you can push down competition and make it hard for them to scale, that's to your benefit. And so it's a real headwind, I think, in the R&D tool side of the ball. Even though you're seeing some amazing technologies that are coming out there, especially that are, AI enabled, that are really providing like really major whole scale advancements in how you're like developing your drugs and
Mhm.
putting and getting the data to decide what assets you want to bring forward, et cetera. But the litigation is a big issue there. And the fact is, on the R&D tool side, it's a much smaller group of people that are willing to acquire. So I think some of the headwinds that need to be abated is one is just getting a little bit more stability. When you think about tariffs like that's an issue that people think about. You don't think about wanting to spend a lot of money for new technologies that you need to develop when you're really worried about your current products and your current market and your EPS next quarter.
Right.
So that's a struggle. On the med device side, I think what we are seeing is actually a decent exit environment on the med device
Hmm.
side. And when I think about med device, there's two different sort of uh, pathways for companies. There's what we call the 510K pathway, which is typically you're just building a slightly better
Right.
mousetrap. And and the idea is like you're going to find a big acquirer that's want to just pick you up and put them in your toolbox, in their toolbox. And so you typically don't need human clinical trials. You get cleared by the FDA to go ahead and sell, but those companies, they have to scale on their sales. And that's
Before an
really
exit.
where
Yeah. Before an exit. Yeah.
you need to get into, 20, $30 million run rate at least before you even get to exit conversations. But I do think the good news there is that later stage capital available for that. And we're actually seeing those deals getting done. And on top of that, we've seen, four IPOs lately in 2025 for med device companies that are scaling revenue, and those companies are actually performing pretty good. So I kind of like where that sector is on the med device side. The second part of the equation are what we call PMA.
Hmm.
There's also de novo, but basically these are companies that have new technology in a big market and they have to do human clinical trials to get to approval before they can go to sell. That those companies, the toggle point for M&A is doing those human pivotal clinical trials and getting the data in hand. Typically, once you're finishing that trial, it takes about a year to actually get approval from the FDA.
Right.
During that year is like your M&A time zone. That's when the strategic come in and it's pretty easy to see whether you hit your endpoint or not. And whether you're going to get approval. A lot of times folks sweep in at that point and pick up the company. And you're seeing the first half of this year was really poor. There was only 3 med device M&A exits, but then there were another 5 in Q3. 2 of them were $1 billion exits,
Right.
Histosonics and OrganX. So I think you're seeing some nice balance there. And the fact that you do have some IPOs on the med device side really does give a little bit more optionality for these companies because now they can say, we could raise another big round, start to commercialize and think about an IPO. So, acquirer, if you want to pick us up, you better do it now.
Hmm.
So I'm hopeful that we'll continue to have that type of groundswell of M&A in Q4. It was very interesting. In last year, 2024, med device M&A, there was like 2 or 3 for the first half, and then there were 9 in Q3.
Yeah.
So it's really weird. It feels like in med device, it's a second half situation. Nobody wants to do anything in the first half. In the second half, we see some opportunities. We're hoping for that. But I think if I had to compare the R&D tool side to the device side seems to be in a much better place right now. And on the tool side, you know, we need to just see, some breakout companies that get to the point where they so strongly outperform the competition that the competition just has to buy them, and they have to buy them for a big dollar amount. And once you start to get that groundswell, that's what happened in, around, 2020, 2021. A couple companies got acquired like Grail and
Yeah.
ArcherDX, and then all of a sudden 4 or 5 other companies followed in quick suit. And so you almost have to get that fear for the acquirers. You better go grab something or they're going to miss out.
As you were talking, you mentioned numbers 2 and 9 and that sort of thing. I'm kind of curious if you look back over the number of years you've been doing this report, and I'm in sales, you're in some form of sales, like the yield, right? So let's say there's a good year in these markets, is tens of sort of exits maybe. So how many placements are made, roughly per year to yield tens of like, can you give me, is it 1 out of every 10, or is it 1 out of every 50, or
Right.
anything coming off the top of your head?
So when you think about it, let's say, for example, in med device, there were last year 407 financings for venture-backed med device companies. On the same note, of the 400, there were 14 exits of at least $50 million up front. So if you want to do the math on that, you can. It's a small
Yeah.
percentage, but I feel like, right now for med device, somewhere between 15 to 20 of those exits a year is a good year for med device. And especially if you're adding in 4 or 5 IPOs on top of it. On the DX tool side, it's a similar number of deals, but the exits have been even less.
Right.
It's been a real struggle in that arena. And so you are seeing, it's like, obviously, like less than 10% of companies are going to get to a good exit, and less than 5%. And it's about being able to be resilient in tough times and just finding a way to get capital, but also making sure that what you're working on has a real need in the market. And sometimes it's a hoped for need that materializes and equals a huge exit. Sometimes the hope for a need doesn't materialize.
Yeah.
It's a little bit, it's a tough game. And VCs, they have a lot of deals they end up writing off, right? I think when you think about their 10, of every 10 deals, they're hoping for 1 huge win, 3 decent wins, a couple that return capital, and the rest go to zero.
Yeah. I'm pretty close to, a lot of startup companies in the diagnostic space. And, obviously valuations can go down in anything, but, in the work that we do at KeyTech, typically we're adding value, right? So we're adding value to these venture backed or angel backed companies. And this was the first kind of past year or two where, really you're still adding value in the work that we're doing, but the market for the diagnostics and tools that you mentioned has slowed down. So the company valuations are going down for no reason other than what the market is willing to pay it for. And it sounds incredibly basic, but just from where we sit with doing product development and step change in value every month, it feels, with the work we're doing, like inventing these products. Even doing that, you're still losing value. It's a very, very challenging environment.
It is. Although I will say, like, when you think about, and I'm, when I think about the highest valued companies on the DX and tools market, it is a mix between R&D tools and diagnostic tests. A lot of it is on the test side, like liquid biopsy
Right.
type companies. That's where you continue to see a lot of support. And it's interesting when I look at the top venture-backed companies in the diagnostic tool sector by post-money valuation. So let's say the top 10, the biggest one in the first half of the year was Colossal. They raised a $200 million round, and their post money was $10 billion. And just so you know, like that financing was in 2025, it was a 6x step up over what they raised in their last round. And this is basically a gene editing development company, getting investment from private equity and venture guys. And when I look at the top 10 of the post money valuation, 9 of the top 10 were step ups in valuation. And when I just say that, I think it's interesting to take that as a point of, you found new investors that are willing to put a lot of money to work in a down cycle at a step up
Yeah,
in
right.
valuation from the last round. And these folks are not dumb folks, right? You're raising $100-200 million financings,
Mhm.
and they're not putting that money around
Right.
willy-nilly. And the fact that you're getting step ups in this area still gives you some cause for, some positive reflection on the industry.
Yeah.
Now, on the other side, you're seeing a lot of Series A folks that are having trouble getting a Series B investor. And you can say, like, that's the other side of the coin. It's really, really hard. But when you do get to sort of the Series B into D, sort of the scale times, you're finding investors that are out there that are willing to pay up to get into really interesting
Yeah.
opportunities.
Cool. All right, so let's talk about the future, and again, let's use the what's coming across my desk, every week. Spin out startup companies from Harvard, from the University of Maryland ecosystem out west. These are bright, founder types that are scraping by with grants, and some fortunate ones are, yielding ARPA H grants and things like that. They're game changers, non-dilutive funding. But, in going to the future, like, what advice do you have for those types of companies that they're developing novel technologies, like diagnostics or tools, but they're facing this environment where, like you say, it's just larger funds, and they don't need 12 because they don't want the valuation where they would be for 12. They need 5. Just can you, in your experience, like, what advice do you have for those types of companies? Because that's where a lot of the interesting work is for somebody like a Key Tech, right? Where it's promising
Yeah.
tech. They kind of want to keep it small until you have data, right? And you're not trying to go too big too soon for all the risks involved with that. So just what advice do you have for those types of companies raising money?
Yeah. Well, I think the first key is to realize that it takes resilience in this ecosystem,
Hmm.
and steadfastness and belief to, like, get your company funded. It's not easy, and I'm very empathetic to that. I see it all the time, and a lot of times it has nothing to do with the people or the product or the technology. It's just trying to thread that needle and find the right fit. And so, you have my empathy. All the companies that are listening to this, it's hard. It's very hard work. Now, what my advice is, and this is something I'm willing 100% to help, and you're hearing, I'm on the podcast saying it right now, like, you guys, whatever you're working on, it's really helpful to understand the state of funding for the type of company you're involved with at the stage that you're involved with.
Right.
Who is raising? How much are they raising? Who are the investors that are putting that money to work? And what do those deals look like? Because again, like, I'm such a focused person on data. Like, data helps inform me. Like, it's great to be thinking about some of the big VCs. If you're looking to raise $5 million, you shouldn't be chatting with those folks. You should be chatting with the smaller VCs that are writing those smaller checks and engaging with corporate to the extent you feel comfortable with your IP, that you can start to have discussions, because you are seeing some of the corporate folks
Yeah,
getting involved
we haven't
early.
talked about that. Yeah, that's a whole
But
other element.
but
Yeah.
but but yeah, but I could give you a cut of the data that shows, let's say, $2 to $8 million financings for a diagnostic company focused on oncology over the last 2 years. And all of a sudden you can see who are the investors that are doing that. Go take a look at those investors. Where are they geographically focused, or are they, specifically focused on diagnostics, or, are they focused on a particular part of that? Are there some family offices there? All of a sudden, that gives you your list to go to in terms of getting in front of these folks to try and build out your relationship. Because if they already are investing in an area that you're involved in, you don't have to do all the
The work for
education
them, right?
that you would have to do otherwise. If you're trying to talk to a biotech investor and trying to convince them to do a diagnostics company and they just
Yeah.
haven't done one, I mean, and not to say it's a fool's errand, but it's a very difficult endeavor.
I mean, that's really valuable. It sounds like you have that market, the market of people with venture funds that are placing these investments. Can you give me a sense, get back to the numbers thing? Like, is it tens to 50 in like diagnostics, for example, or is it like literally like 5 to 10 that are really making solid investments in that space? In which case, it just helps you decide as a founder, like, do I want to do this, or what's a realistic likelihood if I've gone through these five that I'll actually raise the money I need, and maybe I need to do something else.
I would say really it's probably 30 to 50
Okay.
folks
Yeah.
that will do a deal in the next 2 years that are early stage on the diagnostic tool side. And when you think about it on a quarterly basis for early stage first financing of at least $2 million, that's happening in the US and Europe to the tune of, let's say, 20 to 30 deals a quarter.
Yeah.
So just to give you a sense, like it's not a lot of activity and it takes a lot to get it done. But, those are the numbers. But there's 30 to 50 investors that will pen a check to a $2 to $10 million DX tools company in the next year.
Yeah.
And trying to figure out which one that is and trying to make it a match is a difficult endeavor, but that's the game.
Yeah. What about that's awesome. What about 510K and PMA on the med device side?
So on the med device side, that's 20 to 30 deals also a quarter. And I think that is really, really stratified. And actually in my first half report, I actually put together a slide that looks at all the early stage investors in device that are doing these smaller deals, first financing deals, based on whether I've heard about them or they're less known.
Mm-hmm.
And it just to give you a sense, like there's 50 names plus on that page from last year to the first half of this year that I've looked at. I looked them up. They actually have a thesis that they want to do device deals. They've done at least one early stage device deal. It's not like it's a one-off and they've never done a venture deal besides that. It's, these folks are actually out in the market. And so it's as diverse as I said for the DX tool side. I just happen to have a fully formed page in my paper about it.
Got it.
So if you go to the mid-year report and under the device side, you can check it out. But it gives you that's at least a place to start. You go and you look those names up, and all of a sudden you look at their portfolio and you get a sense of what they're doing and how they're doing it.
Gotcha. Yeah. Click on the link below for John's report. All right, John, this has been super helpful. Let's jump to the lightning round. So you mentioned you collect information on the investments and then on the exits. So, what's a highlight on the exit side that we can, end the episode here with, positivity?
Yeah. So I think there's one that we continue to see, especially on the device side, PMA deals get acquired before they get approval. And again, that's so important. It shrinks the time to exit, and it's great to see that happening. On the device side too, I would again say Histosonics, OrganX,
Yeah.
$2 billion exits. We don't see very many $1 billion exits on the med device side. That's really good to see. I would also say on the DX tool side, we did see, one IPO from last year, and that company, was on the tool side. It had to take a 50% haircut in order to IPO from the last private round. But since then, they've recouped that all up back to where, and so now they're actually valued above where they were in their last private round of investment. So again, good news to see on that side. I'm just really struggling to find out any M&A on that side. But those are some of the good news side to the exits, especially on the med device side, where you actually have IPO optionality now. Really good for the sector.
So we touched on corporate investments briefly. I'm not going to ask for names of these companies, but maybe which market vertical or product category maybe would you think is most ripe for corporate investment over VC investment?
I feel like I'm seeing like a lot of LabCorp just getting into a lot of diagnostics plays and point of care plays. Bruker has been active as well, but LabCorp, we've seen them be in a ton of deals, especially on that side. But on the device side, I think most of the corporates have been pretty darn active. I think one super interesting area you're seeing Intuitive Surgical, the surgical
Mhm.
robotics firm, doing a lot, having a lot of activity. They're looking at a lot of ancillary things around the surgical arena and where they can maximize, potential synergy, but they're also just doing it financially as well. So they've been active investors on that side.
Another random question: at what point would a corporate decide to invest or acquire versus sue? Because you mentioned lawsuits, right? And DX and tools. What helps you go down one path or the other there? Do you have any thoughts on that?
I think you don't know until you engage.
Yeah.
So
Comes down to the law. Yeah.
I wish there was an easy, but I would say, I know there's at least one publicly traded company that has like a chief litigation officer, and it's a tools company. So it just shows you like their mentality, and they haven't actually done a lot of investment. I would say one great opportunity to do that, to try and figure it out, is to see historically, are they making investments or not?
Yeah.
And if they're not, maybe you want to stay away from them, because
That's fair.
they may take a meeting just to get
That's
information.
fair.
Obviously, folks who are doing investments are getting information too, but at least they're writing a check
Right.
for things that they like.
Yeah. Awesome. Okay. The question everyone's been waiting for: what impact do you see AI having on this market?
it it's going to have a huge impact, and I think we're already seeing that, like even in the med device arena specifically. Like you had Neuralink raise $650 million in neuromodulation brain computer interface. Another company, Science, raised $100 million, which was a guy who left Neuralink to start another company to compete against Neuralink, I think. And so you're seeing a lot of that both on the neuromodulation side as well as the non-invasive monitoring sensor-based technology. Like, okay, all of a sudden folks who would still be in the hospital are sent home
Right.
with a very complex monitoring system that not only takes your vitals but then has algorithms to predict, where you might be getting in trouble.
Mhm.
I think that's a super interesting area, and I think you're finding that really pervasive in med device. And then on the R&D tool side, obviously the diagnostics side too, you're using AI to leverage and finding trying to find the hit rate, and figuring out why is something happening to a person. And you're seeing some really interesting AI technology being used for that, but also on the drug development side. And you're seeing a lot of computational companies that are focused on servicing basically drug development for biotech and big pharma. And I think that's a really interesting arena. What we're finding is that companies start to invest there, and then all of a sudden they realize that their technology is so good that they start to create their own assets themselves and turn
Right.
themselves into biopharma companies. But you're seeing, like, there's a couple. The biggest financing this quarter is Treeline Biosciences. They raised $600 million, AI computational bio, that they're now developing their own assets around that. And so you do see that is a really intriguing area. And there's a way of going from the idea of a service model and trying to get some collaborations with big pharma into turning that into doing your own stuff.
Right.
I think that's a really interesting opportunity.
Yeah. You almost form like two different divisions of your own business: the service and the product. Yeah.
That's right.
Yep. Yep. Okay.
And you can help one can help fund the other.
Yeah. As long as you keep track of that. Yeah, I mean, super insightful. I think AI, right, driving efficiencies, making clinical trials cheaper. I do worry a little bit about, it's the low hanging fruit is where it's going to be applied. Like I always, just worry a little bit about on the diagnostics front. Like, you're notifying someone so early that something could go wrong, and then it's like, well, what do you do? You're adding inefficiency with this efficient algorithm in a way to the hospital system, and that will all work itself out over time. But that's something that I just observe as these AI
Yep.
funded diagnostic or AI device companies are coming online.
Maybe one other thing on that, Andy, is that I would say, if you're lucky enough to have a really interesting technology that's getting a lot of interest from the investors on the AI side, just be careful to make sure these investors understand what they're getting into on the healthcare side
Mm.
versus the tech side. is we do see a lot of investors that are trying to apply what they've learned generally on the AI side into healthcare, yet they sometimes fail to grasp the regulatory issues and just how difficult it is to sell into the healthcare market.
Mhm.
And sometimes you have like they're just not aware of the process and the challenges. And so sometimes you have to be careful of the valuation versus the value add of an investor and board member.
Right.
And if you're lucky enough to have that situation where you have multiple term sheets and you can look at it and decide, like the idea is like how not only is the money good, but and there may be a difference in valuation, but what can this board member truly help me with down the road to help make my company as successful as possible? Obviously, the dry powder to continue to support the company is important,
Right.
but over and above that, do they have connections with med device companies or the end users or later stage investors they can bring in, et cetera? Think about that in a little bit more big picture. Don't just chase valuation, but on the same note, any money is better than no money.
Yeah, I was going to say maybe a future episode, John, would be, thinking about these mega funds, mega rounds, and maybe these are bad words, but VC is looking more like private equity over time with these big funds, right? So it's not just the
Yeah.
money, it's what you get for that money and the operational support and the connections. And I would definitely be interested to learn more about that and that complete picture, and in the spirit of educating my customers and our industry on what they're buying, if you will, when they talk to these investors and when they do get the money, make sure they're doing it the right way.
Yeah, that's a whole other podcast. I'm
Yeah.
happy. Maybe we'll do it again.
Yes,
I would love to.
sounds good. All right, everybody. John Norris from HSBC, Palo Alto based managing director. Great to have you on the episode, and hopefully to meet you in person one day. Thanks, John.
I look forward to it.
All right, everybody, until next time.
Thanks for tuning in to MedTech Speed to Data, a KeyTech podcast. Join us each month for more ways to get the right data faster to inform critical decisions. Find additional resources on our website, keytechinc.com. If you like this episode, don't forget to subscribe, and please leave a review on iTunes whenever you listen. Thanks.